The income statement helps you determine the viability of your business idea. In this module, you will learn how to create an income statement for your business and how to analyze it. Now, why an income statement? Because it shows the performance of your business for a specific period. So at the end of month one or the end of quarter one or the end of the year, you want to calculate how much sales did you generate, what was your gross profit margin, and what was your net profit. The income statement is going to help you do that. If you're doing a forecast, it's going to help determine the profitability of your business. The projected income statement will also act as a guideline for you. So you can put a sales forecast in there, an expense forecast, and this will really help you control your expenses and calculate if this is a viable business opportunity. When doing an expense forecast, there are a couple of things that you need. The first thing is you need to do a sales forecast. Second thing is you need to know what your cost of sales are. If you're in the food business, it's your food cost. If you're in the fashion business, it's the landed cost of your product. Your monthly operating expenses, you need to know what these are. Your rent, your telephone, your insurance, all those expenses that we incur on a monthly basis, whether we generate revenue or not. You also need to know what assets you're going to purchase to get this business up and running, because you need to calculate the depreciation on these assets. And this is where I'd encourage you to get some help from an accountant. They experience, they do this on a regular basis, and they can help you do a more accurate forecast. They'll understand a little bit about the industry and help you calculate your cost of sales and work out your depreciation for your assets. The other important point for you in business is your break-even point. To check the viability of an idea, you need to know how much sales do I need to generate every month to cover my monthly expenses. And this will help you determine, is this an idea worth pursuing? What revenue do you require to cover all your monthly expenses? You need to know this figure. So you go out there selling your product or service, knowing exactly what you need to do. This is a very important indicator of whether your business will succeed or not. So I want you to spend time calculating what your break-even point is. Sit down with your advisors, sit down with your accountant, and know that number. And remember that it can take a while to break even. The first year, second year, you may not even break even. Ideally, you want to break even as soon as possible, but realistically, it'll take a bit of time. The important thing is that you know how much time. You know that, for example, the first year we won't break even, but the second or the third, it's good to know what this is, because then you're operating, knowing what you're doing, and being prepared for the worst case scenario. Let's understand a little bit more about break-even sales. You need to know your break-even point for a month and a year. And really it depends on the type of business. If you're a very seasonal business, actually your break-even for a year will be more important than every month because it may vary. But you need to know how much sales you need to generate to survive every month and every year. Understand that if your expenses go up, so does your break-even. So be aware of this. You want to make sure that you control your expenses. If your gross profit margin goes up, your break-even comes down. So don't be afraid to make profit on your products, because then that'll give you a number lower to achieve. So if your margin is smaller, you need to generate more sales. If your margin is higher, you'll need to generate less sales. Obviously, this will have an impact on your selling price, so just be aware of that. If your gross profit margin comes down, your break-even point goes up. So if you're going to be offering people discounts, be aware of how much extra revenue you need to generate to justify that reduction in gross profit. Again, advice for an accountant or a bookkeeper or another business owner is really a good idea. So what I'm going to show you now in this case study is how to develop an income statement for a retail business or manufacturing business. Then I'm going to develop one for a service business. I'm also going to help you calculate your break-even point. What I encourage you to do once you've gone through this exercise is to use the templates attached to this video and create your own income statement forecast. So let's start working on this. Let's start with the retail business first. Let's say I'm in the fashion business and my expected revenue for 2015 is $140,000. Okay? It doesn't matter what year you're operating. I'm just using 2015 to use it as an example. Let's say my expected cost of sales is $56,000, which in this case is 40%, and my gross profit margin will be 60%, which is $84,000. What this says is that I expect to generate $140,000 of revenue if I'm doing a forecast. If this is an historical income statement, say for the last year, this would be my actual sales that I've generated. So $140,000, cost of sales $50,000, gross profit margin $84,000. Then let's put some expenses in for this business. Say the accountant is $2,500 because they incorporated. Say I spent $11,000 on advertising. A lot of money on advertising. My bank charges have been $480. My employee salaries, let's say I just had a part-time employee, so my employee salary was $5,000 for the year. Let's say I spent $1,200 on insurance. My salary, I only took a $12,000 salary. My petty cash was $600, and I'm just coming up with numbers. If it's your business, you will make sure that you input your actual numbers or your actual forecast. And you'd probably have more categories of expenses. Just for simplicity, I've kept the category small. Maybe your rent is, say, $6,000 a year. You're subletting, so your rent is not too high. $1,200 a year for your telephone, cell phone, and internet, and your utilities $1,200. Okay, so this tells you that this business total operating expenses is $41,180. Let's say they purchase some assets, computer, some equipment, and it cost them, let's say, $36,000. Spoken to the accountant, and the accountant said their depreciation is about $12,000 a year. We put that in. Let's say they've got a bank loan, and the interest on the bank loan is, let's use the number $1,200, and that's all the expenses they have. So the total expenses, including interest, depreciation, is $54,380, giving them a net profit of $29,620. They pay their taxes. In this case, I've used 15.56%, but you would use whatever your rate is. If you incorporated, it'll be one rate. If you're a sole proprietor, it'll be a different rate. So make sure you get your accountant to help you with this. And the earnings after taxes in this case are $25,000. So you'll see that this is really a summary of what happened in the business over the last 12 months. If I'm doing a historical for the last 12 months, if I'm doing a projection, this is saying this is what I expect to happen over the next 12 months. It's a really convenient document. Important that you know what this is. And you'll see on the right-hand side here we have some ratios. This will tell you what your cost of sales is, what your gross profit margin is, and then these percentages on the side here are all divided by revenue. So what it's saying is that your accounting fees are 2% of your revenue, your advertising is 8% of your revenue, your employee salaries are 4% of your revenue. So your accountant would discuss this with you at the end of the year. The nice thing about these percentages, it'll make it easier for you to forecast the new year. So make sure you analyze these percentages on an annual basis with your accountant. The other thing we have here is the break-even point. Okay, so this is how much sales this business has to generate every year to survive. How do we calculate that? We took the total expenses, which is $54,380, which includes depreciation and interest on loans, and we divided by the gross profit margin, which in this case was 60%, giving us $90,633.33. So you've got access to this template. I encourage you to use it, to sit down with your accountant and ensure that you do a forecast for every year. If you're in a startup stage, this is going to help you test the viability of your business idea. So spend some time. It'll really help you build a business. Let's look at a service business now. Let's use an example. Let's say I'm a consultant. I'm operating from home. I don't have any employees and I don't contract out. So I'm going to try and keep it as simple as possible. Let's say that my projections for next year are $60,000. Okay. My accounting fees, let's say I'm incorporated, so it's $2,500. I've spent $6,000, or I plan to spend $6,000 over the next 12 months. So let's assume we're doing a forecast here. Because remember I said earlier on, this could be for the last 12 months or it could be a forecast. In this case, we'll do a forecast. The bank charges are $480 a year. Employees, we don't have any employees yet. Insurance is costing me $1,200. So I'll take out liability insurance or errors and omissions insurance because I'm a consultant. Let's say I'm going to take a salary in the first year of $24,000. My petty cash will be $600,000 a year. This is my forecast. My rent, I'm renting a small office, so let's say $6,000 a month. Again, this is a small office. My telephone, cell phone, and internet, let's say it's, let's say $1,500 for the year. My utilities are $100 a month, so let's say $1,200. Again, let me just emphasize that what I've done here is I've entered only a small range of expenses. And the reason I've done that, it makes it easier for me to do this exercise. In your business, you would include some more rows and include all your operating expenses in there, whatever they are. So in this case, this business has got operating expenses of $43,480. Because it's a service business, the depreciation will not be high. Let's say they bought a laptop and a desk, and let's say it cost them $6,000. For the accountant said your depreciation for the first year will be about $2,000. You put that in there. Let's say they took out a loan, and the interest is $50 a month, so $600, and they've got no other loans. Okay, so the total revenue for the year was $60,000. This is their projections. The total operating expenses was $43,000. Okay. Then they had the depreciation, which they got to add in, which is a total of $2,600 depreciation and interest. And their total expenses amortization is $46,000, giving them a net profit of $13,920. Okay. You put in the taxes. In this case, I used an example of 18.6. Because remember, the tax rate that you pay will depend on if you're incorporated or a sole proprietor. Your earnings after tax will be $11,000. So this gives you an idea of whether this is going to be a viable business or not. How much revenue do you need to generate every year to break even? Your figure's $46,000. So you need to charge out $46,080 every year to cover all your expenses. So it gives you a number that you know. So you can calculate how many hours is this? Is it doable? Is it viable? And then base your decision on numbers rather than guessing. Okay? So think of the income statement. In this case, I've done a projection, but it's also historical at the end of the year. At the end of the year, your accountant will do it for the previous 12 months. Really useful document and something you should analyze with your accountant annually. Sit down with them, discuss it. It's going to make you a better business owner. So let's just summarize now. I encourage every one of you, develop an income statement forecast. It really helps check the viability of your business idea. Doing forecasts is not easy, but you did your cash flow forecast, so you've got a whole lot of the numbers already. All you've got to do is convert them now into an income statement. Get some advice from your business advisors or your accountant. It's going to make it easier for you. Know what your break-even sales are. This is important that you know this. How much revenue do I need to generate every year to survive in this business? If you can break it down into monthly numbers, it's even better, because then you've got numbers to work on a monthly basis, goals that help you keep focused. Analyze your income statement annually with the help of your accountant, and I encourage you to sit down with an accountant because they're working with numbers all the time and they will understand what the percentages mean, and they can explain to you how you're doing relative to the previous year or compared to other similar businesses in your industry. So here's an exercise for you. Create a 3-year income statement forecast for your business. Year 1, year 2, or year 3. At least 2 years, but let's say 3 years. Year 1, year 2, year 3. This is really going to help you check the viability of your business. Calculate your monthly break-even sales in year 1. You can do it in a year and then break it up into a monthly. But really it keeps you focused and it gives you numbers to work with. And it's going to make you a better and more effective business owner. This is a really useful exercise. I encourage you to spend some time with us. You've got the templates. Get some advice and guidance, but do the exercise. It's really going to help you. For more information, please contact Enterprise Toronto. They can help guide you through the process as you develop your business plan for your startup. I wish you the best of luck.